particular section is whatever are relatively other issues that come up with capital budgeting, as well as something important which is called the NPV rule. Right now, what is NPV rule is nothing but a set of basic rules that have to be followed while projecting the cash flows. Right, so it's while projecting the cash flows where a set of rules have to be taken care of, and that's where these NPV rules become important. So let's take a look at some of these data points. Till now, we know that we need to discount the cash flows to arrive at the net present value of a project. If positive, the project should be undertaken. So the rule is known to us broadly, how we use the NPV thing. We've also seen how to calculate the discount rate, right? Now we need to turn our focus on the actual cash flows. So broadly, we know that cash flows need to be discounted. There are still some set of rules that are available which tell us what needs to be included and what needs to be excluded. So practically, we are going to look at inclusions and exclusions from the cash flows, right? In order to kind of see what is going to get discounted. We'll take a lot of examples to understand this in more detail. And broadly, this is what is known as the NPV rules. There are broadly a set of 4 rules, right? The first one of them, only the cash flow is relevant and should be discounted. We're not looking at accounting income, we're looking at only cash flows. What are those cash flows? We will look at those. Always estimate, that's the second one. Always estimate cash flows on an incremental basis. So only the cash flow is relevant. Then incremental basis is what is required. What do we mean by that? We will look at examples of this. We have to be consistent with the treatment of inflation in our projections and in the numbers we're looking at. And we have to separate the investment and financing decisions of the firm to find out what is giving us the benefit in this entire rule, right? So that's the NPV rule. Let's look at these 4 sub rules and segments of these rules and understand examples of these to gauge how do we interpret those. First one, only cash flow is relevant. Accounting income, remember, is not important from the perspective of present value calculations. We've already seen how income may not be equal to the cash flow, right? Income has attributes like depreciation, which are essentially non-cash charges. Income has an assumption that everything has been received, but in truth, in real world there are receivables. Income assumes that everything has been paid, but there are payables as well. All these get adjusted in the cash flow, right? So cash flow is what is the exact amount of money that you are generating. Obviously, over a period of time, the income needs to kind of be similar to the cash flows over the timing of the entire project. But otherwise, cash flows and their timing is important. So for example, I could do sales of 1000 crore in this year, and there are 2 instances. One, I recover 100 this year and 900 next year. The other instance is 900 this year versus 100 next year. This is the receiving of money, right? So that's the cash flow, and these are the sales. Now, in both the instances, obviously, the second one is considered to be better because the timing is important, right? Non-cash charges like depreciation are added to the accounting income, while capital expenditure and changes to working capital need to be subtracted, right? This we've already seen in some of our other topics that we have discussed in subjects like FSA, where when we construct the cash flow, we do all these adjustments to the income, right? Now, what are the common mistakes that happen during these cash flow projections? The first common mistake is that we forget about adjustments for working capital. We completely miss that out a lot of the times. That's important to kind of incorporate, right? For example, if we are building the cash flow starting with net profit, remember that we add depreciation or any other non-cash charges, then we subtract any kind of capital expenditure. A lot of the times we just stop here, right? That's a mistake, because if receivables went up from 100 to 200, right? If receivables went up from 100 to 200, that means 100 crore of cash has not been received. So you have to subtract any change in receivables, similarly any change in current assets, and if payables, for example, went up from 0 to 100, you were supposed to pay this 100 but you have not, which means you have added cash. So you add any change in payables, and similarly other current liabilities, right? These combined together give you a negative change in net working capital, right? So change delta, I'm using the symbol delta for change, that combine and give you the cash flow statement. So remember that this adjustment has to be done while calculating the cash flow. Sometimes we forget that working capital may change over the life of the project. So those individual year-on-year changes also have to be kind of considered. And finally, remember that all receivables will come back to you at the end of the project. So at the end of the project, and this is important, working capital will be recovered. So let's say we have adjusted for working capital, but in the last year, you will receive all the payments. You will make all the payments, right? So effectively, receivables will go to zero, payables will go to zero, working capital that is stuck in the business will get recovered at the end of the project. So you have to ensure that these adjustments are made, right? Let's take a quick example. A project sees the following transactions. What would be the cash flows, right? So net profit is 100, depreciation is 25, capital expenditure is 45. What is the formula? We take net profit plus depreciation minus capex minus change in current assets plus change in current liabilities. So let's do that. That's 100 plus 25 minus 45 minus 30 plus 35. Remember, increase in current assets is subtracted and increase in current liabilities or any change in current liabilities is added, right? The signs will automatically then take care of themselves. So what is this? 125 minus 45 is going to be 80, minus 30 is going to be 50, and plus 35 is going to give me 85, right? That's my cash flow for the year. And we need to remember that all these adjustments need to be made before we get down to discounting of the cash flow, because then it gives us a clearer picture about how the project is giving money, and we are essentially discounting the cash flows only, right? That's the cash flow discounting that we have seen. Let's move to rule number 2, which talks about incremental cash flows. Remember, we had said that there are a set of rules that only the extra cash that you get out of a project is what is to be added. There are some sub rules within this consideration. Let's take a look at them. The first one is, remember to include taxes. Do not confuse average with incremental payoffs. Include all incidental effects. Include the after sales cash flows that may come later. Include opportunity costs. Forget sunk costs or ignore sunk cost. And remember salvage value. Now we'll look at examples of each one of these or understand each one of these in more detail. Remember to include taxes. Remember that taxes are real cash flows. They are cash outflows. We need to include taxes in our calculations at any point of time. We cannot ignore any kind of taxes. That's a simpler one to remember because tax is like a cost and a real payment of money that is happening. It's a straight cash outflow. So we have to kind of incorporate that. That's a simpler one to understand. Some of the other ones are more interesting. Do not confuse average payoff with incremental payoffs. Right now, let's say a firm has two kinds of projects. There is a good project and there is a bad project. The good project on average gives a payoff of Good project on average gives a payoff of, let's say, 100, and a bad project gives a payoff of only 20, right? That's the average payoff. Now, it's quite possible that if you invest more in the good project, if you keep investing more in the good project, the incremental payoffs are like 50, 30, and so on and so forth. They are lesser payoffs. So this is the incremental payoffs. If you invest more money, you're already getting 100, but if you invest more money, you're only going to get 50, 30. Here, you're getting 20 on whatever you've invested, but incremental payoffs may be 60, 70, 80, right? Sometimes bad projects may give turnaround opportunities if we do more investment in them. So remember that this 100 and this 20 is not important. That's already happening. The new investment is only going to consider what incremental cash flows we are getting, which is this 50 and 30 and this 60, 70, 80. So we do not confuse what has already happened or what is going on in a project at this point of time. There is a fair chance that there is a possibility of getting better payoffs in terms of incremental cash flows that we get from any kind of project, right? That's something that we need to remember. The third one, include all incidental effects. Right, now remember that when you take a project, there are side effects, right? There are byproducts. You launch a new product, an existing product may suffer. You launch a new product that might actually help an existing product. Let's take two examples. If a company launches a new gaming console, let's say a company like Sony launches a new gaming console like PlayStation or something, the existing player sales will get affected, right? So these negative effects have to be considered in your cash flows. So if your cash flow is coming as 100 and you're losing 20 in existing players, the net cash flow is 80 that you have to consider. Sometimes you may see positive effects as well. So assume a flight is being launched between Coimbatore and Chennai by Jet Airways. Now this in itself may not be a profitable flight for them, right? This may be unprofitable. They may not make a lot of money, but it may increase the flow of passengers from Chennai to other cities, making other flights more profitable, right? Now, these are positive effects that need to be included. These are side effects. These are not the effect of the exact flight. The flight might give you only 100 or in reality minus 100, but the positive effects might be plus 200, which basically, so this is the flight and these are the other flights, right? You could possibly get, maybe you're running a flight between Chennai and Mumbai that is unprofitable at this point of time, but with the extra inflow from Coimbatore coming in, that flight becomes profitable, right? So that's possible that there are positive incidental effects or negative incidental effects. You have to consider those in your cash flow calculations. You have to look at cash flow calculations carefully, right? The company might be able to sell some spare parts or services even after the sales have happened. Let's say you're a machine company that sells a machine. You might in future get service and spare part orders. They need to be included in your projections, right? If you are an aircraft company that sells an aircraft, over a period of time, you will get service orders, you will get spare orders as well. So effectively, these need to be included in the sales picture. Sometimes you might be actually purchasing an aircraft as a company. So a project might be purchasing of an aircraft. Purchasing of an aircraft needs to kind of look at these as incidental additional costs that will come in at a later point of time, right? So that also needs to kind of get captured when you're looking at cash flows, that just the sales may not be important. You may have other incidental cash flows like services or spare parts that might come at a later point. You do need to include those into the consideration as well, right? Then we move on to including opportunity costs. Now, if you're using a resource for a particular project, there may be opportunity costs associated with it. So for example, if you use a land for the project, the land can no longer be sold in the market. So if you take the project, the land value is zero. But if you leave the project, right, then land can be sold for, let's say, 1 crore, right? this 1 crore is opportunity cost. If you take the project, you are foregoing this 1 crore value. You are leaving out this 1 crore value, or you are losing out the opportunity to get this 1 crore. The moment you use this land for your project, you have lost out the opportunity to sell this, and hence the cost of that, it's like you're acquiring the land for your business purposes. This 1 crore has to be included in the capital expenditure or capital outlay, because you're no longer going to be able to value this land. So that's the opportunity cost that needs to be included. Now, just opposite to this, there are some other kind of costs which are sunk costs. These are costs that have been undertaken, or costs that have been already taken. These have to be excluded, right? So for example, let's assume there is a company that is setting up a DVD manufacturing unit, right? And they've taken some expenditure of 100 crore. So they are planning to manufacture DVDs, and they have put up 100 crore for that. Now they realize that technology changed, right? And the focus is more on USBs, the pen drives that we have. So now they want to evaluate whether they put up a USB unit, right? The cost outlay for that is, let's say, 500 crore. Now, do they include this 500 plus this 100, because this 100 is also gone, or do they only include the 500? Remember, this part is gone now. It's already taken. This is sunk cost. You are not going to recover it regardless of whether you take the project or you do not take the project. If you take the project, it doesn't matter. Even if you leave this 500 crore USB unit, this 100 crore is gone now. So what is gone is gone. What you're not going to recover is sunk cost. You do not include sunk costs in our calculations. You have to forget or ignore sunk costs. Now it's a tricky thing. You do need to kind of sit and evaluate, and we'll look at an example that helps us kind of look at some of these data points, right? Then the final one is, you remember, salvage value. After the project ends, the cash flow should incorporate any kind of salvage value that you may get by selling the plant and the equipment. So if there is a salvage value, you do need to incorporate for the salvage value. At the end, by selling whatever assets you have and repaying the liabilities that you have, what is left as the value is what is known as salvage value, and that needs to be incorporated in your cash flows, right? So lots of sub segments, sub rules that we have looked at. Let's take an example. Now let's say Apple is considering setting up of a new manufacturing unit to kind of manufacture new generation iPads, right? iPad 6, 7, whatever. They are going to generate that. This would entail an initial cost of USD 10 billion and is expected to generate cash flows of, let's say, USD 3 billion for a period of, let's say, 6 years, right? Uh, they're planning to discontinue an existing capex where they have already invested USD 5 billion, since they do not find that line of production to be economically viable. They're going to use a land for this, which has a market value of USD 1 billion. The plant may have no salvage value, and this new line of iPads may cause a loss of sales in existing iPads. The cash impact is USD 500 million every year. Show the cash flow streams that need to be accounted for, right? Now, let's look at a few things in this. What are the data points that we have? We have a capital outlay of 10 billion, right? We have, there is an existing capex where they've already included 5 billion, right? What is this? Because this is not economically viable, so they can't recover this. So this is effectively sunk cost. What do we do with sunk cost? We ignore it, right? We forget the sunk cost. There is a land which they're going to use, which is for USD 1 billion. What is this? This is opportunity cost, right? what do we do here? We include this. The opportunity cost is to be included, right? And then there is a cash impact of 500 million. This is loss of sales. So that's a negative 500 million every year. What is this? This is incidental effect of the project, right? And incidental effect is negative in nature. So we have to kind of take care of that as well, right? Let's look at what happens. It's at 6 years. I think that has to be corrected to 5 years here. So let's see, the cash flow from the project says a capital outlay of 10 and then 3 for a period of 5 years, right? There's an opportunity cost. That opportunity cost is 1 that has to be included in the capital outlay. That makes the net cash flow of minus 11 in the first year, right? Then you ignore sunk costs. We ignore the sunk costs, right? So this $5 billion that we had already put in is not needed. We remove that out. At the same time now, what happens is we look at what is the negative impact of this 500 million every year. So minus 500 million gets adjusted every time. So that's minus half a billion, which gives you a net cash flow of 2.5, 2.5, 2.5 in each of the years as you go ahead. So your net cash flows that you're going to look at, which are essentially your incremental cash flows, are these minus 11 and 2.5 for a period of 5 years as per this particular project. That's how you make adjustments in any given project about all these data points. That's how you go about projecting incremental cash flows, right? Let's look at some other things then. The third one, the rule, is use inflation consistently. Remember that if you're considering discount rate in nominal terms, and remember nominal rates, if you remember, we have discussed this, nominal is real plus inflation. That's an approximate formula that is there. So if you're using nominal rates, then cash flows also have to be considered in nominal terms. That's usually the norm. Why? Is because when we do calculate sales, we just look at units multiplied by the price, right? This is usually nominal because the price comes into the equation every year, right? So we use the nominal terms in general. However, it is absolutely fine if you are using real terms. But in that case, you have to use real for both the discount rate. So you have to use a real cost of capital and you have to use real cash flows where you adjust for inflation in both of them. Now, you may need different inflation rates for different parameters if you're using nominal numbers. That's because you have to price in different things like prices of goods sold or wage increases or manufacturing cost increases or marketing cost increases. They could be different. So when you're projecting this, inflation numbers need to get projected. Usually because data is collected from markets and markets talk in nominal numbers, right? Price of a particular product being sold is identified and salary is identified. Here you are going to use nominal numbers most of the times, but you can use real numbers. Just remember that if you're using nominal cash flows, you use nominal discount rates. If you're using real cash flows, you use real discount rates, right? Real discount rate, for example, if nominal discount rate for a project is 12% and inflation is 5%, then logically your real discount rate will become 7%. So you use this. If you use this consistently, then you'll obviously get the same answer, right? The final one is separate investment and financing decision. Now suppose you finance a project partly with debt. Even then, the cash flows are to be considered as per 100% equity financing, right? Hence, you will not make any adjustment for interest payments or debt repayments or debt raising, etc. It's assumed that you're funding the cash flow completely using equity. Why do you do that? This is to allow the separation of benefits of the investment decision, which is being calculated using NPV, with the financing decision. That's a separate decision, right? So whether the project is viable has to be calculated assuming 100% equity, and then you can choose another method to figure out whether you want to kind of fund it with debt. So for first principles, we need to identify that the NPV being calculated, the project is viable based on 100% equity financing. So we don't make any adjustments about debt in the cash flows, right? Advanced studies will talk about where do we make this adjustment for financing, capital budget, capital structure of the company. But at this point of time, just remember this rule for our understanding, right? Those are the NPV rules, 4 of them that we have seen. First one being include taxes, second one being incremental cash flows, third one being inflation treatment has to be consistent, and fourth one being investment and financing decisions have to be separated, right? Finally, we come to some other issues that come up with capital budgeting. One also needs to check while looking at capital budgeting the incentive structure of the company. It may give rise to what is called as agency problems, right? Remember, managers are decision makers for companies, and agency problems could result in a lot of things. For example, reduced effort by managers. If they foresee that their compensation is not going to get impacted by an extra effort, they might put in a lesser effort, which might result in a negative impact on projects, right? So for example, less marketing done for a particular project, right? Then you could have perks. Now, while compensation is recorded in a straightforward manner, there are some decision makings that the firm might do or management might do based on what perquisites they get. These could be, for example, they have to get a loan from a particular bank, right? So bank one is giving them, or let's take instead of bank, let's take suppliers. Supplier one is quoting 100 rupees. Supplier two is quoting 105 rupees. Ideally, we should go with supplier one. But what happens if supplier two gives some sort of perks or extra benefits, not to the firm, but to the management, right? Then there is an issue, right? Because the management might get, for example, things like extra tickets to the World Cup cricket matches, and for that reason decide to go ahead with supplier two instead of supplier one. That's the perks issue. Empire building is essentially a scenario where, regardless of what is the outcome of the measure, managers tend to create big entities, right? There is this enthusiasm of managers where they say we will kind of create huge entities because it kind of appears under their management and it appears that they are really big if they are managing big entities. Sometimes these are negative projects that are taken. There are time and again examples of mergers and acquisitions that companies have done which have failed purely because the management wanted it to kind of showcase a very big entity under them, but in reality it was not economically viable, right? Risk taking, sometimes you see enhanced risk taking because of compensation structures. If the management has a tenure of 2 years, then you want to maximize what you can do in those 2 years, right? So a bank might go out aggressively giving out loans, right? Just to showcase better numbers in terms of market share, but that's going to come and create a problem at a later point of time, right? So these are issues which come up and they're commonly referred to as agency problems because the management could take some of these things and essentially create a problem in terms of what kind of projects are chosen for the stakeholders of the company. How do we address these? Typically, the simplest solution is monitoring. Who monitors? There is generally a corporate governance structure where the board of directors of the company and auditors of the company will basically monitor this, right? So board of directors is sometimes independent directors, some other eminent businessmen who are not necessarily working in the company. They will oversee all the performance of the management of the company, what kind of decisions are being taken, right? Auditors audit all the accounts. So all kind of accounts such as financial accounts, compensation accounts, etc. get audited in terms of understanding who has been paid, what has been paid. The auditor's responsibility is to tell whether all correct due processes have been taken care of in this process, right? Sometimes lenders will do a monitoring. So if you have loaned out money, the bank might restrict certain transactions, saying that how will you pay my loan back, right? Similarly, shareholders might sometime restrict things. Recall in our example in our financial statement analysis course, there is an example of Crompton Greaves. The company management wanted to buy an aircraft, but the shareholders basically rejected that proposal, right? So sometimes the shareholders may also end up doing some sort of monitoring, and that is what is important in the context of our overall issues that agency problems create. How do we address those problems? That could be done using monitoring. So that's broadly it in what we had to discuss under financial management in this term. We will extend this when we move to the next term and start discussing on a more applied basis what kind of corporate finance activities companies take. But primarily, this is what is to be covered at this point of time. So that's it in this particular section.